Hi, everyone. Thanks for joining us today. My name is Nathan Sadowski, Wealth Manager with Pacific Excel Wealth Advisors. Today, we're going to talk about the first quarter 2026, what happened from January 1st to March 31st, as well as what we see moving forward with the markets. A lot going on with wars, tech, as well as the rest of the markets. We're going to go over the economy, where it stands now, where it's headed, as well as thought leadership from our research team at AssetMark. First, we're going to take our eyes to the right-hand side right here. Spike in oil. Oil has spiked up right around when the war started in late February, early March. Prices per barrel jumped up. As we can see in Brazil and US, they're what's called countries with a net energy import surplus. So Brazil and the US supply enough oil for their own countries, and then their excess, which is their surplus, is sold to other countries. Where China, Germany, and Japan, they import more than what they produce. So the US and Brazil are in good standpoints right now. On the left-hand side, we're going to look at the S&P 500. At the end of March, it was down negative 4.3. Not too bad. Feels like it could have been worse. We take our eyes straight down. Client having a moderate portfolio, 60% equities, 40% bonds, was down about 2.3%. Not too bad. What I want to show you here is the 1-year marks. So 1-year average return on the moderate portfolio was just under 14%. And even the 3-year was about 11.2%. So still in very good shape for the current circumstances anyways. Talk about the economy a little bit. And economy is holding steady. And this is driven mainly by ourselves, just living our daily lives, supporting ourselves. We got to, eat, going out to travel, sometimes going out for dinner. The consumer, as we can see on the left-hand side, it's nearly 70% of the GDP, of the gross domestic product for the US. Other contributors are business at about 18%, government at about 17%. The trade, which is a -3%, is mainly because of the tariffs with all the other countries and those higher prices. So those are starting to settle in as well. On the right-hand side, we can see GDP growth in 2024 was about 2.8%. You take right now, the US is a $30 trillion $30 trillion economy. And it's a lot harder to grow. So when you're getting those single digits, 2 to 3% growth, it's not a bad situation. 2025, last year, economy grew at about 2.1%. Forecasts and predictions right now for 2026 are at about 2%. So still in good shape. One of the biggest drivers right now, the GDP, is the spending in AI. So I want to talk about that a little bit. On the right-hand side, in 2025, 40% of that growth, which you saw at the 2.1%, was driven by AI, putting into data centers, into chips. And the companies that are mass producing this and putting a lot of dollars in there are your Oracle, Microsoft, your Google or Alphabet, Meta or Facebook, and then Amazon. And you can see each year is getting a little bit bigger. 2023, under 200 billion. 2024, over 200 billion in spending. 2025, over 400 billion. And you can see in 2026, the estimate here is going to be over 650 billion. A lot of dollars. Just to give you some context, the whole country of Japan in 2025, their gross domestic product was 650 billion. So basically 5 tech companies are producing as much as one country. It's a developed country as well. So we're seeing a lot of money being put in here. AI is a real thing. Where does AssetMark, your investment research team, see where everything's headed? It was more in the green zone beginning of the year. Now we're at the neutral, as you can see on growth and inflation. And we want this war to settle out. Both parties want to come to some type of agreement and basically get this settled, make sure the Strait of Hormuz opens up. The consumer, we're starting to see less spending. Big corporations, we're seeing the AI, as I talked on the last side, they're still putting in mass dollars into there for the AI. And government, we got the big beautiful bill that passed last year in 2025. We're still seeing some credits for businesses as well as individual tax returns in your 1040. And those are going to tail off at the end of 2027, early 2028. So it's like front end loaded. You're going to get some tax refunds in the beginning. After 2028, those are going to go away. Inflation, if the price per barrel keeps creeping up, we're going to have some inflation problems. And shelter as well. We're starting to see major cities, San Francisco, New York, a lot of that rent is now coming down. So that's where we can see another problem is on the shelter. Energy, not as much for inflation. We're also seeing oil prices higher. We want to see them back at about $100 a barrel. Right now they're at like 104, 106 a barrel. So the higher the barrel goes, the higher the inflation is going to be. So we're watching this and we're still neutral. We're not cautious. Wars have been a part of history. Right now we got a couple going on. I still remember back in 2001, my brother gives me a call as my first year in college, and he's like, "Hey, just turn the TV on." Seeing all in New York, all the buildings on fire. I mean, it was a very scary thing. We lived past that. He did the 10-day drive back from New York over to California. But as we can see on this chart, the point of this is, going back to the late 20s after the Depression, markets are going to have those highs and lows. Long term, it keeps growing. But wars are part of this. One thing I want to point out is we got midterm elections coming up later in November, and markets are going to get volatile. Happens, there's patterns in here. This goes back over 46 years. On the right-hand side right here, in mid-March, market had dropped down negative 9.1. On the quarter, it was down a little bit over 4%. Wholly changed, in the last 3 to 4 weeks here. We're now positive 5%, but that end of March clipping, markets were down. And we can see here, 07, it was down, over 30%. Average drawdown is about 14. So far we've seen 9.1. Obviously, there's probably more to come, but do expect the market to get volatile here in the next few months. Once the midterm elections settle out and we know what's going to be happening, markets tend to get back to normal. Key talking points. The economy right now is still growing. It's just not growing as fast as 2025 or 2024. It's limited impact to the growth and inflation. So if the conflict is short-lived, the better. If this starts to drag out, we're going to have some slow growth with increased inflation. AI is huge. It's here to stay. A lot of investments going in there from the big corporations. We're also still getting some tax benefits from the stimulus here, from the big beautiful bill. So it's going to help provide some buffer. Oil shocks are usually temporary, but that's what we don't want to see long term. We want to see this short term, because the longer it drags out, the more problems it's going to be for growth. The growth will slow down. Cost of gas is going to increase at the pump. Big key takeaway for investors: history shows market impacts on these wars, geopolitical events. Usually they're short-lived. Countries tend to want to make agreements, and as I stated earlier, volatility will rise, but long-term trends remain intact. Our big takeaway is we want to stay diversified. We want to fish in many different ponds. We want to minimize that downside risk. So these plans we built for you are here to navigate. Thank you so much for watching. Look forward to talking to everyone soon. Thank you.